Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor. I'm really pleased to have with me once again John Rubino. And John is well known to this audience by now, I'm sure. But just for those of you who may not be familiar with him, he runs a very popular website called dollarcollapse.com. And I would suggest you jot that down, bookmark it, and go there because John writes an awful lot of great things there and a lot of other people that he adds onto that site that contribute some very worthwhile ideas and updates on the market and what's going on. John has a background in New York City on Wall Street years ago. We won't hold that against him because he's recanted and now he is a free market advocate. He took his MBA from New York University, and he was a Eurodollar trader, junk bond analyst as well, and an equity analyst too on Wall Street. So he has a great background in the financial realm, and but lives now in Idaho, where he's decided a more sane place to live. Welcome, John. It's really good to have you with us again.
Thanks, Jay. Good to be back.
Really, always good to talk to you. James Grant has, I think, correctly stated that the current monetary system, at least in the Western world, he's called it the PhD system, as opposed to the gold-back standard that we had. PhD standard as opposed to the gold standard. Do you think? How do you think the PhD boys are doing?
They're doing as well as they always do. You can go back through history and find so many instances of governments deciding that the laws of finance or geopolitics or whatever shouldn't apply to them, that they can transcend them. So they put together the smartest guys they can find and let the experts run things. And the experts always fail because you cannot violate the basic laws of the universe for long. You can bend them for a little while, but eventually fundamentals win out. And so, look at the Vietnam War. We brought in the best and the brightest to run it, and it was a total disaster, probably our worst geopolitical experience in our country's history. And now we're deeply into the monetary policy version of that, where we've got these guys in charge who basically believe they can run the system better than markets can do. Mm-hmm. And so they're manipulating everything in sight, and in the process, they're short-circuiting all the price signaling mechanisms which are what make capitalism work. You can't have capitalism without prices being set by market participants, which then send signals to other market participants and cause them to do things that lead to the efficient allocation of capital. That's how capitalism works. And, you take that part away, and all you've got is a bunch of guys blundering around blindly, throwing money at stuff that might or might not be a good idea, and in the aggregate turns out not to be a good idea, and then the system collapses. We're headed for that.
Yeah, well, indeed. You take away price discovery from the capital markets, essentially, by pushing and forcing interest rates to zero. Then what happens to the allocation of capital, right?
Yeah. So you end up with central planning, which has been tried many times throughout history, where you put a bunch of guys in a room and say, okay, tell us how much steel we need to have and how much copper and how many houses should we build and how much wheat should we grow. And these guys make numbers up out of thin air, try to impose it on people who really couldn't care about their opinions, and the system fails. And so
John, we have guys from Princeton, Harvard, and Yale, and MIT. These are brilliant people. They're not people with IQs of 100. These are brilliant people, and you're telling me that a whole bunch of people with an average IQ of 100 acting collectively can do a better job of allocating scarce resources than a few of these brightest people with IQs of 180 plus?
Yes. Market economies are vastly more complex than the human brain. So there's no way for an individual person or a group of people to figure out a market. It's just too big for them to understand. And it's also driven in large part by the emotions of the people who are, at the grassroots making decisions about capital. So you can't impose a will on that. The central planners living in the country's capital can't look out 1,000 miles away and decide what has to happen to a farm or to a school or to a roadway or whatever and have their decision make any sense. That's just how life works. And so governments over and over again find this out really painfully. And, they fail in an attempt to manipulate markets, and then they have to go back to letting the markets do their thing. Because otherwise, there's no point in having markets if the markets aren't going to be allowed to operate according to pricing signals with individuals deciding how to allocate capital, because that's how markets work. So, yeah, we're I don't know how far we're into this, how close the end is, because they've kept this thing going so much longer than they should have been able to. I thought 2005 was the end of this, and instead we've got a whole nother cycle, a whole nother bubble being blown up. So
a bigger bubble, and the whole thing is, of course, that once you suppress one market and you don't allow that market to work efficiently, it affects other markets. So, for example, Lawrence Summers is well aware. We know that from his article in Gibson's Paradox, that in fact if you suppress the interest rate, you also have to suppress the gold price. You have to push the gold price down. And so they've been doing that. I have no doubt about it. I don't know what your thoughts are exactly on this, John. We talk to David Jensen on this show on a regular basis, and he talks about the phantom, or let's say virtual COMEX market, in which a couple of major players can go in and just swamp the market with futures contracts, highly leveraged futures contracts that are purchased with money printed out of nothing, out of thin air. Go in and basically drive the gold price down at exactly the time when anxiety is rising, and you would expect loss of confidence against fiat money. But how far can they push this, and do you see any reason? I mean, what I really want to get to here is an article that you recently wrote, and I would suggest to our listeners you go to dollarcollapse.com and read this article titled, "Did Gold and Silver Just Get Their Greenspan Put?" Talk to us a little bit, John, about the Greenspan put. We know about the Greenspan put when he was Federal Reserve Chairman. He had a put under the market, and he wouldn't let the stock market go below a certain level. That was the concept, at least. He would start pumping money into the system. I think we're doing that in spades now with the Bernanke and now with the Yellen Feds, probably more than ever pumping money into the system to try to keep the stock market from collapsing. But talk to us about a Greenspan put on gold.
Yeah, well, basically the Greenspan put was the government telling the big banks and the financial markets in general, don't worry, we got your back. If you can speculate in any way you want to, lend to anybody you want to, and if you get into trouble, we will come in and bail you out.
Yep, and they did.
Yeah, they took that to heart, so the leveraged speculating community now runs the world because they know they can't lose. And so what happened lately in the gold market was that the guys manipulating the market, and Zero Hedge just had a great article with a really telling chart in it, showing that $1.5 billion worth of gold futures contracts were dumped on the market at basically lunchtime on the Japanese market. When everybody was out to lunch, somebody came in and smashed the price down by selling a bunch of futures contracts, which is exactly the wrong way to get the best price, right? And you wait till the market's nice and liquid and people can buy what you're selling. Sure. You don't wait till they go out to lunch and then just smash it down. So obviously that was an attempt at manipulating the market, and it worked.
So the best price wasn't their intent?
No. Well, I mean, they wanted the best price, but for them the best price was the lowest price. They didn't want to get the highest price, as a normal seller does.
Yeah.
But so what happened in this last smackdown, though, was that China came in and basically said, we'll take all the gold in the world. And they bought, for a stretch of a couple of months, all the gold that's being produced by the world's gold mines. And then India stepped up their gold buying, because India's a long story, which we probably don't have time to get to, but lately they're buying more and more gold as well. And Russia, who's mad at the U.S. for a variety of mostly valid reasons, and has been buying a lot of gold lately, stepped up their gold buying. So you saw these three countries buy way more than the gold that's available from gold mines in a given year. Yeah. And at the same time, individual buyers of silver coins swamped the coin dealers out there. The U.S. Mint normally sells, in a good month, maybe 5 million 1-ounce silver eagle coins. Well, last Wednesday, in 2 hours, they sold 2 million of them. And it completely tapped out their inventory. They had to stop selling coins. They're going to start again on the 17th. Under allocation, where they'll make some, they'll sell as many as they as they make, but they won't give you all you want because there aren't enough of them anymore. And so it's possible that physical buyers have now put a floor under precious metals, or are close to putting a floor under precious metals by saying, all right, look, at these prices, we'll take it all. You just give us all the gold and silver that you can come up with, and we'll buy it at these prices. And if that's true, that means the physical market is now contending with the paper market to determine the prices in precious metals. And that's been the holy grail of gold bugs forever, is the physical market swamping the paper market and setting prices much, much higher than the paper market wants them to be set.
Sure.
And so we're seeing signs of that now. We don't know if this is it, but when it happens, this is what the early stages of it will look like. So that was very encouraging. A lot of fun to watch.
Well, it certainly is. And David Jensen's been talking to us about backwardation. I don't know if the markets are still, the gold market is in backwardation today or not. Do you check that, John?
No, I see reports of it.
Yeah.
And so I don't know what it is today, but it did go into backwardation just lately here. And basically what that means is that it costs more to buy gold, physical gold today than it does to contract for it in the future, which is the opposite of the way it usually works.
Right, because people may be doubtful whether they can get it in the future.
Yes,
that may be one of the reasons.
Exactly. It's a sign of shortage.
And it's a very, very unusual occurrence, and especially for gold where there's so much of it above ground. So, well, what happens though, John, if now more and more people are saying, wait a minute, we don't want to just trade this phantom gold, we don't want to just trade contracts, and cancel them out with winners and losers at the end of the contract period. We want actually to take this gold now. Then what happens to the gold price? That we could see prices rising very dramatically, possibly?
Yeah. I mean, we could see a shortage leading to a default on a metals exchange like COMEX, or just the evaporation of supply from dealers, for 1 ounce gold and silver coins. And at that point, either the paper market has to go way up to accommodate this new market reality, or the premiums. The paper market still sets prices, but the premiums that you have to pay go way up. So in other words, the price might be $15 for an ounce of silver, but you can't get silver for $15. You got to spend $22 if you want a silver eagle or whatever. So in that case, it's the physical market that's determining the real price, the prices at which you actually get your offer satisfied. Mm-hmm. And so in that case, then it becomes clear that there's a shortage of precious metals out there. And so then you get panic buying. The people who have decided that they missed the boat and that they could have had it at 15. Well, now they still want it, but they can't wait for it to go down anymore because now it's 22. And so they go in and they just say, all right, just whatever it costs, just get me that 10,000 ounces that I've been waiting to buy. So then you see a short squeeze where everybody who's betting on precious metals going down gets steamrolled, and then they have to close out their short positions at any price. And so you see basically a run on precious metals.
Yeah, well, indeed, it certainly could be what's happening. It seems to me at this point in time. But of course, John, those of us gold bugs have been talking about this for a long time, and it's been a long time coming. So if it's, I think people shouldn't hold their breath on this situation.
No.
But certainly there are signs out there now, and with the global economy in such, I think, really bad shape, it's for the reasons we just talked about. Defying market reality and not allowing markets to operate efficiently is causing all manner of problems in the capital markets, and it's leading to a lack of production and cash flow to service the enormous amounts of debt that keep growing very dramatically. We are unfortunately out of time, John. I just want to mention to my listeners, though, there's another article that you recently wrote, and we didn't have time to talk about it today, called U.S. Now Importing World's Deflation. Well, deflation, inflation is a very interesting topic. We have to have you back on to talk about it. We talked about it before. But it's sort of like a knife's edge, it seems to me, that could go either way, couldn't it?
Yeah. We've got huge deflationary forces in the market, which is all this debt we've taken on. The debt is deflationary, and then all the money we're printing is inflationary, and they're kind of contending out there. So it swings back and forth between different countries. Right now, it's the U.S.'s turn for deflation. That was the point of the article. Yeah,
well, it certainly seems like, again, it gets to psychology, and if people decide they don't want to hold dollars anymore and they want tangible items, the velocity of money starts to turn over, and then all of a sudden the dollar or whatever the currency is can lose its value, and then prices as denominated in that currency can go up very, very rapidly. So this is not a good thing. We don't want to see the gold price rise because of all this human misery and difficulties that are coming. I'm a gold investor because I believe the things that you and I have just talked about, defying the natural markets, are going to cause big trouble. And that's why I think you and I both would agree on. That's why we are gold investors and silver investors as well.
Yeah, totally agree, Jay. It's just a question of timing now, not if but when. And that's the big question, because we're in uncharted territory.
We sure are. John, unfortunately, we're out of time. Thank you so much for coming on the show. And again, folks, it's dollarcollapse.com. Go there, read John's excellent work, and other writers, too, that are featured there. Thanks so much for being with me, John.
Thanks, Jay.